It's official, the winter price reset has begun, and those shiny new rigs from summer are blowing up Q4 like a ticking inventory bomb. Dealers who couldn't move units in July are drowning in carrying costs now, and the only escape is to slash prices hard and fast. Some of these deals are so deep they're actually confessions. But here's the twist no one's talking about. Every markdown triggers another drop, pulling used prices and trade values down with it. This isn't a sale, it's a survival reset. And if you're buying this winter, the fallout could save you thousands. Here's where the reset really starts. The summer that wouldn't sell. By late summer, something snapped in the RV market. Dealers who bragged about record waitlists last spring suddenly couldn't give units away. Shipment data showed more than 31,000 new rigs built between May and August. But thousands never left the lots. Across drone footage from Indiana and Texas, rows of untouched motorhomes stretch like parked airplanes' plastic still on the seats, window stickers fading in the sun. The problem wasn't weather or fuel prices, it was miscalculation. Manufacturers kept running at pandemic speed, while real demand cooled quietly. Every brand new rig that sat through July turned into financial quicksand by September, carrying insurance, storage, and interest costs that compound every single day. A dealer sitting on 50 units at $100,000 each is burning nearly $30,000 a month just to stand still. Now, as winter arrives, those unsold rigs can't simply wait for next year. They have to move fast. The markdowns starting this quarter aren't marketing flair, they're debt triage. It's not about clearing space, it's about survival. And the deeper those red tags go, the clearer the truth becomes. The reset has already started, and the biggest price drop in recent memory is quietly unfolding right now. Those full dealer lots weren't victories. They were silent liabilities waiting to crush quarterly financial breathing room. Dealers in inventory lockdown. Walk into a dealership today and you can feel it, the tension under every handshake. Managers are staring at spreadsheets that look more like countdown clocks. Floor plan loans. The financing that keeps RV stock on the lot. Don't pause for winter. With interest rates north of 7%, every unit sitting still costs real money. One Midwestern retailer revealed that carrying expenses for September alone topped $48,000. Multiply that across several stores, and you're staring at a slow-motion crisis. The solution? Drop prices before the lenders start asking questions. A Class A that listed for $215,000 in July now flashes $187,500 online, and that's before negotiation. In Arizona, one family dealer cut an entire row of fifth wheels by $20,000 each overnight, just to reduce monthly debt exposure. These are not incentives. They're rescue missions disguised as deals. For the first time in years, the leverage has flipped. Buyers aren't chasing inventory. Dealers are chasing buyers. The winter price reset isn't just happening, it's accelerating by the day. They can't hold the stock, so they'll unload it, whatever it takes. As carrying costs pile higher each week, even the best-stocked showrooms begin feeling dangerously exposed. If you want the real numbers before anyone else sees them, make sure you're subscribed. Hit like so this reaches more people, and stay with me, because what's coming next could change how you buy for the rest of this year, when new turns cold. Walk through any large dealership today and you'll see it. Brand new rigs that no longer feel new. Their stickers still read 2025, but buyers can tell they are leftovers. The shine looks tired, the rubber starts to dull, and even the sales team avoids eye contact when you ask about build dates. That's because time is money, and time kills value. Depreciation usually starts when a customer signs the contract. This year, it started while units were still sitting on the lot. A fifth wheel listed at $130,000 in July now advertises at $104,000 on the same VN number. That's a $26,000 drop without a single mile logged. Multiply that by dozens of rigs, and you can see how a so-called new model can lose $600,000 in paper value before Thanksgiving. Buyers who paid full price in early summer now face immediate negative equity. Trade that same model in next spring, and it will book at maybe $90,000. Dealers are watching their margins evaporate in real time, forcing them to classify unsold rigs as aged inventory. The industry's code word for problem. That's not clearance. That's survival pricing. With margins stripped bare, survival means triggering markdowns early before next year's arrivals flood the same floor. The winter window opens. By October, the first national clearance campaigns started rolling out. Major outlets in Michigan, Florida, and Oregon dropped coordinated advertisements showing year-end reset events, slashing prices up to 20% below MSRP. Screenshots from dealer flyers confirmed markdowns across multiple lines. A Class C at $110,000 down to $88,000, a towable at $52,500 reduced to $42,000. Some even offered deferred payments through the first quarter of next year just to move stock before audit season. The reason is simple. Every January, manufacturers push new model year inventory. If dealers don't clear space now, they pay double, once for current stock, and again for incoming orders. The winter window becomes the only chance to reset the books before lenders call. That's why we're seeing deeper cuts than any holiday sale in the last decade. It isn't generosity, it's necessity for cautious shoppers. This short season represents rare leverage. When lots overflow and time runs out, negotiation flips, dealers stop selling and start surrendering. The proof is right there on local listings. Same models, new titles, thousands cheaper than they were 60 days ago. What happens next flips the buyer-dealer dynamic for the first time in years. While prices begin tumbling nationwide, the real story unfolds inside dealer offices, scrambling to stay afloat. Unprecedented markdowns begin. By November, the markdowns stopped looking like sales and started feeling like confessions. Dealers from Ohio to Nevada began posting below-cost clearances that undercut manufacturer minimums. A Class A motorhome, once listed at $230,000, now showed an online price of $195,000. Another listing from a Texas outlet offered a fifth wheel originally priced at $94,000 down to $72,500. Screenshots of those ads spread across Facebook groups and forum threads, with comments reading, "They've never gone this low before." It is no longer a negotiation tactic. It is damage control. Dealers who survived on slim 3% profit margins during the boom years are now facing monthly carrying losses in the tens of thousands. Several public listings confirmed units sold within a single weekend at discounts usually reserved for auctions. The markdowns ripple by brand, too. Forest River, Keystone, and Jayco all appear in listings with price cuts between $12,000 and $25,000 on models under 1 year old. What looks like a buyer's paradise is actually a liquidation event dressed as a holiday special. The real motive isn't generosity, it is debt avoidance. But some discounts go beyond profit. They reveal desperation. When the discounts look unbelievable, it's worth asking whose balance sheet is bleeding behind that number. The numbers behind the slashes. To understand these markdowns, you have to follow the money trail buried inside every deal sheet. A new RV, priced at $120,000, might carry an invoice cost of around $108,000. That leaves a spread of $12,000 before factoring in hidden costs. From there, the dealer owes floor plan interest, roughly $700 per month if the unit has been sitting for 6 months. Add insurance, utilities, and staffing, and the real holding cost reaches nearly $5,000 before it even moves an inch. Dealers also rely on holdback, a small rebate from the manufacturer, often 2 to 3% of MSRP paid after the sale. That cushion once protected profit, but now it only patches losses. If a dealer sells that same unit for $104,000, they're losing $4,000 on paper, but salvaging a line of credit before year-end audits. A leaked regional memo from a Midwest distributor confirmed that several lots have been told to reduce exposure at any cost, essentially trading short-term losses for survival through the winter quarter. Every deal of the year ad you see is a calculation, not an act of kindness. Once you know this math, you'll never read a sticker the same way again. Once the arithmetic sinks in, every dealership starts rewriting its rulebook to survive another fiscal quarter. Dealers change the playbook. The old model was simple: order early, markup high, and let demand handle the rest. That playbook collapsed the moment inventory stopped moving. Across the Midwest, several retail groups have paused or outright canceled new factory orders for spring. Their storage yards are full, their lenders impatient, and their sales teams exhausted. Instead, they've turned to creative damage control, bundling leftover new units with used trade-ins to clear space faster. In warmer regions like the Sun Belt, where year-round camping continues, the strategy looks different. Dealers there are experimenting with consignment sales, letting private owners list rigs on their lots to draw foot traffic without adding new debt. Others are partnering with local banks to offer temporary financing incentives that cut rates by 2 percentage points for the first 6 months. These moves aren't generosity, they're survival chess. One sales manager admitted privately, "We stopped thinking like a dealership and started thinking like a liquidation house." The industry that once controlled supply now negotiates against its own calendar. Their survival plan becomes your leverage window. Amid shifting tactics and shrinking margins, a clear divide emerges between the winners and the worn-out, winners and those who miss out. Not every shopper will walk away ahead. The current correction rewards timing and patience more than anything else. Those who held off through summer now see deals dropping fast enough to justify waiting even longer. Buyers who locked in loans back in August at high interest rates are discovering they overpaid by $10,000 or more, simply by being too early. Meanwhile, lenders are tightening approval standards, meaning those with weaker credit could miss the window entirely. In northern states, winter weather adds another layer. Dealers desperate to unload stock before snow sets in are offering delivery incentives, storage credits, or prepaid maintenance, perks that rarely appear in warmer markets. In Florida and Arizona, inventory still moves steadily, so markdowns are smaller and expire quickly. The pattern is clear. The colder the region, the deeper the discount. What this means is simple. The best opportunities belong to those ready to act before year-end audits close books in early January. After that, inventory adjusts and prices start climbing again once new models ship. Next, you'll see how these lot-level deals shake the entire market. While the sales lots fight their last battles, the tremors begin spreading deep into manufacturing corridors. Model year collision course. By late November, factory lines were already preparing to push 2026 models into circulation, while 2025 inventory still crowded dealer lots. It is a logistical collision with financial consequences. Manufacturer shipment reports show more than 28,000 new units scheduled for release before March, despite roughly 15,000 still sitting unsold across major dealer networks. The industry built for growth and is now trapped in its own pipeline. This overlap means dealers will soon display both model years side by side. To the eye, they look nearly identical, same chassis, same layouts, yet one is suddenly worth thousands less, because the badge reads a different number. That difference turns every remaining 2025 build into instant old stock. A motorhome purchased today at a discount can lose another $10,000 in book value the moment the next year version ships. Manufacturers once counted on buyers ignoring that detail. Now, with every data tracker and forum thread documenting it, the illusion of value fades faster than ever. In an industry built on perception, losing that edge is catastrophic. That overlap could erase another layer of resale value overnight. As new models overlap, the ripple spreads, undercutting used prices faster than any ad campaign can spin. Used market chain reaction. The used market has always shadowed the new, but this year it is moving in lockstep and downwards as dealerships slash new unit prices to clear space. The reference points for used valuations reset in real time. Auction sheets from early November show travel trailers that fetched $32,000 in August, now closing at $27,000. Black Book wholesale averages have fallen nearly 9% since midsummer, marking the sharpest drop since 2019. Private sellers are feeling it first. Listings that once drew immediate responses now sit untouched for weeks, forcing owners to cut prices just to compete with dealer markdowns. Trade-in offers have shrunk by thousands, leaving many owners upside down on loans they expected to clear. The data confirms what every used lot operator quietly admits: when new rigs get cheaper, everything beneath them follows. For buyers, that means opportunity, but for current owners, it spells equity erosion. Some who bought early this year could lose $20,000 in resale value before spring. It is a reset no one planned for and no manufacturer can stop. Even sellers who thought they were safe are now underwater. Falling resale values turn from rumor to reality, forcing factory boards to cut output and reconsider risk. If you value straight talk, backed by proof, Subscribe now. The next report's already in motion, and it's one most buyers won't hear about until it's too late. Stay ahead, stay informed, and never overpay again. Factories feel the strain. Inside production plants from Indiana to Oregon, the noise level has dropped. Where welders once worked 2 shifts, many now run on shortened schedules. Internal memos from several manufacturers confirm temporary production cuts of between 15 and 20% heading into the first quarter. Executives cite market realignment, but employees know the truth. Storage yards are full, and cash flow is tightening. One publicly traded manufacturer released revised earnings guidance in early December, projecting revenue down by nearly $150 million compared to the previous year. The statement framed the slowdown as a strategic recalibration, though insiders describe it as an emergency brake. Suppliers feel the strain too, as orders for components like slide mechanisms and composite panels dip sharply. In interviews, one plant manager admitted, "We used to measure success in output. Now we measure it in efficiency." That quiet shift in language signals the end of a growth era and the beginning of a preservation phase. Consumers will see it next year when flashy concept builds give way to conservative designs focused on durability and cost control. If output slows, expect fewer flashy models and more cautious builds. Production slows, but interest doesn't. Financial pressure keeps ticking, demanding liquidation before loans reset once again. Seasonal clock and credit crunch. Every December, dealers face a familiar reckoning: floor plan loans. The credit lines used to stock new RVs come up for renewal. Under normal conditions, banks roll them over easily. But with interest rates hovering above 7% and sales lagging, renewals now come with strict audits and higher collateral demands. A dealer sitting on 50 units at $100,000 each carries $5 million in inventory exposure. Add rising rates, and monthly interest alone can exceed $30,000. Dealers are liquidating fast ahead of January audits, as even a 0.5% rate hike adds thousands in annual costs. Final push ads before holidays aren't marketing, they're survival. Time and credit pressure collide, forcing sales before margins vanish. Lenders seek recovery, dealers need cash, and buyers unexpectedly gain leverage. The coming weeks will decide who endures and deliver the steepest deals of the entire year. After the financial dust settles, a new playbook begins forming for every smart buyer left watching. Play the reset smart. Now that the market has cracked open, timing and precision matter more than enthusiasm. The smartest move is to treat every deal like an audit, not an impulse. Start by verifying the model year stamped on the manufacturer's data plate. Many lots are advertising units built in late 2024, but titled as 2025. That difference can cost you thousands in resale value later. Ask for the actual floor plan date, the day the dealer began paying interest on that rig. The older that date, the more leverage you have, because every extra month bleeds their margin. Forget chasing another $1,000 off the sticker. Negotiate real value instead. Ask for extended coverage, upgraded tires, or free delivery. Confirm warranty dates match your purchase, not arrival. Keep every document in writing. These details cost dealers little, but protect you greatly, turning negotiations from pressure into control and ensuring you steer the deal, not the lot. Before sealing any handshake, remember trade-in numbers often decide who actually wins at closing time. Trade-ins and timing traps. Falling trade-in values are the silent budget killer of this reset. Many owners walk into a dealership believing their 2-year-old rig will fetch close to what they owe. Then, the appraiser walks out with a clipboard and a number $20,000 lower than expected. That gap isn't trickery, it's math. As new unit prices plunge, every used equivalent follows. Dealers adjust trade-in values weekly, using wholesale guides that track auction data. Those guides now show month-over-month declines of 5 to 8%, which means your RV loses value faster than you can pay the loan down. Trade values usually stabilize after 6 to 8 weeks, but each passing week erodes another 1,000 or more. Focus on total transaction balance, not inflated trade numbers, and insist on real discounts instead of ledger tricks. Always verify comparable listings before signing. In a falling market, patience safeguards equity hesitation, however. can erase the entire deal. While values sink on paper, factory floors are rewriting how survival looks in the coming year. Industry rebuild for next year. Inside boardrooms and production plants, the tone has shifted from ambition to survival. Manufacturers that once bragged about capacity expansion are now planning leaner production schedules. Several internal forecasts show total national output expected to fall by roughly 15% during the first half of next year. Rather than chase record volume, factories are focusing on profitable lines, smaller towables, compact Class Cs, and fuel-efficient builds that appeal to cash buyers. The flashy luxury segments that once defined the industry's marketing budgets are quietly shrinking. Dealers are recalibrating after the winter squeeze, cutting inventories to 60 days instead of 90. The shift lowers costs but limits buyer choices, marking a return to practicality and service over show. Regional distributors are merging to streamline operations, signaling a new era of cautious growth that will determine which brands endure through next spring. Far beyond production lines, these adjustments reveal a cautious economy learning patience after years of excess beyond winter. What this signals: every correction teaches a lesson, and this one is no exception. The winter reset isn't just about discounted rigs. It is a reflection of a country learning to value patience over hype. The same inflation that drove factory costs higher and borrowing tighter is now forcing both buyers and sellers to rediscover discipline. When production shrinks and prices realign, the people who wait, verify, and demand proof come out ahead. The RV market reflects a wider financial shift. People are finished paying tomorrow's prices today. Caution has replaced hype, and companies are being forced back to reality across housing, travel, and every luxury sector. Slow decisions and verified facts now rule. The frenzy era has ended. Those who remain calm amid volatility win the strongest deals. Timing and proof outweigh promises. In this quiet reset, patience becomes profit, and wisdom turns into lasting financial strength for the careful few. If you found this breakdown helpful, hit that like button so more RV shoppers see what's really happening right now. Drop a comment below and tell me what prices look like in your area. The more data we share, the stronger we all get. And if you haven't already, make sure to subscribe so you don't miss the next update.